So,
Amazing.
Charles, we always start off one of our Zooms by asking, who is Charles Seaman? And how did you come to Cash Flow Champs, and how did Cash Flow Champs come to be?
Good questions. Well, I'll start with the second one first. So Cash Flow Champs came to be because I was in a prior partnership and we split ways at the end of May 2022. And at that point, I was trying to figure out what the future held for me. And I initially started working with Prashant and Ryan, who are two of the partners in Cash Flow Champs. We have a big team. And we had worked together on some different deals on a deal by deal basis. And one of the things I really liked about both of them was that I knew they had strong work ethics. And I knew that was very important to me with anybody I partnered with. So I promised myself I wasn't going to rush into another partnership. I said I would take my time. And by the end of the month, I think I kind of had the groundwork laid for Cash Flow Champs. So we hit it off, we hit the ground running, and then we added three more partners. So we actually have a team of six. But the idea is that we can do more in-house, and even though we have a bigger team, it allows us to be more versatile and be in more places and cover more ground. And for me personally, I've been in commercial real estate for a while, as you said. I was very fortunate to work for a guy who was a commercial real estate investor in New York for 14 years. And the reality is that provided me better training and better education than I could have ever gotten in any boot camp or any weekend course, even though I have been to many of those. But it's hands-on experience and getting to work with somebody that was very successful and to learn a lot from him. And for me, my objective has always been, like many of us here, is to build financial freedom and to build a solid foundation for ourselves and our families, and to put ourselves in a different position with that.
That's awesome. So Charles, tell us, what was it, that made the shift for you into the space, right? I mean, were you also active already in the single family space? Who exposed you? Where did it make that? Where did that spark come from?
So I would have to say it actually came from my old boss. The reality is we almost have a father-son type relationship, and I probably learned, really more from him than I could have from anybody. And when I first started there, I was 20 years old, and what I say jokingly, but probably very truthfully, was that I was young, dumb, and broke. And I didn't have a lot of ambition when I first started there. I just needed a job. And when I first started there, the goal that I had was that I would stay there maybe 2 or 3 years and then eventually go out and do my own thing. But life happens. You start making more money, you start getting more responsibilities, you think you're important. And lo and behold, 2 to 3 years turns into 14. So he had several different businesses and investments, and I was able to help him manage all these different things. So it gave me exposure to different industries. And the one that I knew that I gravitated most to was commercial real estate. But I also knew that I didn't have the money myself to go out there and do commercial real estate. So in 2014 and 15, I started dabbling in single family and wholesaling. And I realized two things pretty quickly. One, I didn't like single family, and two, I wasn't good at it. And not to say that
Why is that, Charles? Why is that? Real quick. Why is that?
So good question. So there's different skill sets you need to be successful in both. And with single family, what I find is it's more transactional, which isn't necessarily a bad thing. But where I do my best work is when I can build a relationship and use it over and over and over again, and vice versa. And that's what the commercial real estate side is suited for. So it's very much a relationship business. It's a who you know more than what you know business. And you have to get in front of the right people, and you have to be able to build relationships. And for whatever reason, I guess I've always had a knack for that. I jokingly say there's not much I'm good at in life, but I like to think I'm good at that. So
Love it. So what happened then, Charles? So then single family, right? You said, not me. What
right.
happened then that led you to multifamily?
So I kind of took a step back. I was still working the job at that point full time. And in 2016, I saw a free seminar, one of many, and it was for Dave Lindahl's company, RE Mentor. And I said, okay, let me go to it. And by that point, I'd been involved in many different education programs for a lot of different things, everything from stock trading to eBay to different types of real estate. And I promised myself, and I said, I'm not going to spend any more money on education until I start making something back. I need to actually take action and do something. Because like many people, you pay X number of thousands of dollars for a course, you go there, you get fired up, you take the course, and then you go home and you don't do much. So that's usually what I wind up doing. I say, okay, I'm not going to do this again. But I had a lot of friends that had spoken very highly of Dave's program, and I said, okay, you know what? I really want to be in the commercial side, and I'd like to be doing these types of deals. And when I went to the free presentation, I said, okay, syndication. This could work. I could use the skills I already have. I could do the deals I want to do. I can use other people's money. So I said, okay, this is a win. So I wound up taking some courses with them in 2017 and 18. And pretty much as soon as I went to the first 3-day weekend that I actually paid for, the one thing I did different than previous 3-day weekends is I actually started taking action when I came out of it. So, from the point of, mid 2017, I said, okay, I didn't have a lot of free time because my job, I usually worked on the low side 60 hours a week, and there's quite a few weeks I worked 90 hours. So,
what
I
is
think
that
I-
job, Charles? Real
What's
quick,
that?
what is that? What was that job?
So basically, I was managing all different businesses and properties. The guy that I worked for was a serial entrepreneur. He was a small business owner, but I was more or less helping him run everything that he had.
Got it.
So it
You
was,
learn
Oh,
through
yeah.
that as well then, right? This
Yeah.
is something I think, just to touch on that real quick, a lot of people in our community, including myself, actually struggle at times is if your W-2, doesn't add value to your real estate career, that can be hard on a mindset perspective. So there's different levels of W-2, right? If your W-2 is already in the industry where you want to be successful on an individual level, that's already level 2, I would call it, right?
right. I would agree with that.
Yeah.
And
Okay.
the reality is, my boss really was my mentor. I mean, even though we didn't have that title, I mean, the things that I learned from him just without even realizing it, were great. So that definitely supported it. And then from that point, I knew that I had to use my time strategically. I said, okay, well, most days I didn't take a lunch break. I mean, I'm sure I could have by law, but it wasn't company culture. Nobody did. So I said, okay, I have to start making time. And whether it's 10 minutes, whether it's 15 minutes, 30 minutes, whatever I can get away for in the afternoon, let me schedule phone calls in advance. So that way there's a known commodity, a known time, and I'm not just calling somebody out of the blue and seeing if I get them or not get them. And whether it's talking to brokers, attorneys, whoever it was, I said, I have to use whatever time I have wisely. Because most nights when I would get home from work, it's probably 11:30, midnight. And I said, okay, nobody's going to want to talk to me at those times. So anybody I had to speak with, I knew I had to schedule in advance. I had to set something up during the day. And then at nighttime, I said, okay, if I go home and I underwrite a deal, I can do that at 2 a.m. It doesn't make a difference. I mean, it's not my first choice to think to do it 2 a.m, but you can do that. So it was just figuring out how to use whatever time you had productively, and then, capitalizing on that little by little as it starts building up. So what I always tell people in this business, we're not doing rocket science or brain surgery. It's just consistency. You need to be consistent, and you need to find time to do it day in and day out.
I think you're fully right there, Charles, because it's not just real estate, it's actually growing as an individual first, right? If you're not ready for it, then that's what you need to work on first, right? And I know that's something that we had to learn too, is to make that time consistently, because there is actually a lot of time, especially for us, right? Trevor, Victor, 2 children, spouse, job. I mean, there really isn't much time, especially if you want to make it consistent, not this week like this week like that, and maybe I can, and maybe I can't. So that's the big thing, right? For me, the key to I wouldn't call success, but to move the needle was to use the morning for like administrative work, so to speak, like individual work, essentially. And then lunch break was, I know Trevor knows that he can schedule a call during Eastern time lunch break, for example. And then I pick different slots in the evenings that are, matter of fact, aligned with my wife, crazy as it sounds, but that's really what it is. And that's what helped us, right, Trevor?
That's exactly right, man. To sync up like that. And I really like what Charles said. All right. I just want to make sure the audience catches that. If you need to speak to somebody in the real estate space and you need to underwrite a deal, make sure you do your underwriting after hours where you can't speak to anybody. Like, time block that underwriting in the evening or early in the morning before people get up and rolling, right? But then those calls that you need where you need to interact with people, make sure you do that during the regular work day at some point in time, right? 10 minutes, 15 minutes, 30 minutes. So I think that was a nice little strategic time use nugget that I think could be very helpful, because a lot of us here, We used to have our W-2s and a lot of different things going on.
Prime time, the golden time, right?
Yep, that's right.
So Charles,
Right.
you figured all that out, right? You were able to now start taking action. What did the next few steps ahead of you look like? What happened once you started taking consistent and intentional action? What changed?
Well, what I realized is I started making progress. Now, initially, when I first started out, what I was shooting for were properties that were 100 units and larger. And the reason that I wanted those properties is because I knew they were large enough to support full-time staff, which makes it easier to run the property. So what I also learned, it took me a little while to learn this, is that it's a lot tougher to win a 100+ unit property when you're brand new than to go out there and to win a smaller property. So it took me about 2 years to get my first deal. And what I realized, it was a
Real
couple.
quick, Charles,
Yeah.
can you repeat that for everybody
Absolutely.
here? Okay.
That's
Because
right.
I
That's
know
right.
this is a big one, right? How long
Right.
did it take you for your first deal after you took consistent action?
2 years.
I mean, guys, who in here, I want to see that in the chat. Who here is frustrated after being in this business for, let's call it 6 months or so, and is not yet having their first deal? Who's frustrated? Like who has see, I mean, this is so real, right? But the truth, I mean, really is, and Charles is another example for that, right? It can take time, and that's the tough thing, right? That's what spreads the successful one from the one that now goes into Amazon business, go back to eBay, or whatever the case, right? Okay.
Yep, very true. So then from there, what it came down to is, just being consistent. What I realized is little by little, I was making progress, but I didn't feel that I was getting the result I wanted. And, thankfully, so let's kind of start at the beginning. October 2017, I'd probably been looking for deals for maybe 3-4 months by this point. I came very close on a 96 unit deal in Ohio. And I'm thankful I didn't win that, because what I realized is I didn't really have any of the pieces in place. And you know how they say, find a deal and the money will come? That's great with a single family home. That does not work great with a 100 unit apartment building.
Yeah.
Okay, so let me be clear on that for a few reasons. One, if you're syndicating, most times the legalities are going to require you to have pre-existing relationships. So you can't just go meet somebody tomorrow and say, oh, do you want to be an investor in this deal? And secondly, if you're doing it with a single family home and you need to go out and find $100,000 or $200,000, it's a lot easier than finding $2 or $3 million. I venture to say, out of the attendees here, that if you asked enough of them, you can find quite a few that might have $100,000 or $200,000 for a single family home. But there's probably not too many that are going to have $2 or $3 million in cash laying around that want to invest in a single deal. So,
Right.
so you want to really be building both buckets. And with that first encounter taught me was that, okay, I need to start setting some things up. I've been spending all this time finding deals, but I need to go out there and build sponsor and key principal relationships, because I didn't have one of those. And I wasn't in a position at that point to go out and sponsor a loan. So if nothing else, what that experience gave me was an opportunity to connect with key principals and to start building relationships. And ultimately, the guy that sponsored my first deal, I was probably working with him for a year before we got one done. And I brought him a lot of different deals. But now keep in mind, guys, when you're bringing deals to sponsors, you want to make sure you're vetting them. If you're not vetting them, they're going to quickly hit delete and not reply to you. So make sure you're doing your homework and you're sending them good stuff to look at. And I would send these deals, we put offers in, and for one reason or another, we didn't get accepted. So after about a year of doing this with this particular sponsor, the sponsor said, do you want a 92 unit deal? So it came the other way around. He thought of us because he lives in the Atlanta market. Most of his deals were in the Atlanta market. He knows the Atlanta market like the back of his hand. And that was not really a market we were actively looking at that time. And he knew we were serious because he could see that we were hungry. He could see we were putting offers in. We just weren't getting them. So he was doing 200 and 300 and 400 unit deals. So he had no interest in a 92 unit deal at that time. And he said, what do you think? Do you guys want to do this one? I know the area well. I actually tried buying this property myself a few years ago, and he owned the property pretty much right down the block. And when I underwrote it myself, I like to think I'm fairly conservative with my underwriting then, back when I first started, I was too conservative and something probably many newer people are guilty of without even realizing it. You're guilty of it because you don't know better. And when I underwrote it myself, it didn't work. But I thought to myself, well, this guy has 2,500 units. I have none. This guy lives in Atlanta and knows the market well. I don't. And this guy's doing a lot better than I am. So I said, okay, maybe he knows something that I don't. So I decided to run with his underwriting, and then we went forward, and that wound up being the first deal. And ultimately, we used that to catapult into the second one. So for anybody who was at Deal Maker Live this week, and one thing you always hear Michael Blanc talk about is the power of the first deal or the law of the first deal. I will second that 100% because it opens doors and people start taking you legitimately. Even if you have just one, it's a lot better to have one on the scoreboard than none. It opens a lot of doors for you.
Agreed. Charles, I want to inject a question here really quick about you when you mentioned underwriting. Obviously, you don't want to be under conservative in your underwriting. That's really bad. You don't want to be too over conservative because you'll never win a deal. Your numbers just aren't there, right? So where do you see kind of that sweet spot, or maybe let me rephrase it like this way. Where do you see kind of in the whole underwriting, all the different factors that can be considered in underwriting? Where do you see that those one or two variables that people kind of dial in and they're just too over conservative on?
There's two things I would say. So the biggest one that I see people conservative on is rent targets. And I think that people sometimes are unrealistic. So I think it's one thing to be conservative, and it's another thing to be too conservative. So let me give an example. So I usually use the syndicated deal analyzer most times for my underwriting, but whatever tool you're using, I usually compare the effective gross income for the actual numbers versus the effective gross income for my pro forma. And if the pro forma I have is less than where the property is performing currently, the first thing I would ever ask you is, why would you want to buy a property where you believe the income's going to go down? So that's the first question. But then I would look at it and say, okay, if you want to be conservative, you keep the in-place numbers. Don't lower the income. If you're lowering the income, I would tell you you're looking at the wrong property to begin with. And the second thing I would say, I don't see as many people conservative on this, but it's a huge mover and shaker in the underwriting, is your terminal cap rate. Next to purchase price, that's the second biggest factor. And that alone can really make or break deals sometimes.
Yeah. And I think, I mean, we've been there, or
any
sometimes
kind of insight on how to dial in that terminal.
Go for it, Trev.
Sorry, what was that?
Go for it. I think he might have had some connections, but I think he's asking, like, if you can go a little bit deeper into the exit cap rate. I think that's what you mentioned.
Absolutely. So the one challenge with the exit cap, let me just preface this, guys, is that there's a lot of guesswork in it. So it's certainly not an exact science because you're trying to predict what the value of something might be in 3, 4, 5 years from now. And unfortunately, none of us, or most of us, probably don't have that ability. If you do, you should probably go ahead and play the lottery. But what you're doing is using a combination of where the market is right now in real time, information that you're getting from resources like brokers and other investors, and your own personal perspective on where you see the market heading. So for anybody who doesn't know, let's start at the top. The exit cap or the terminal cap are the cap rate when you go to sell the property on the back end, or when you go to refinance it if your plan is to refinance. So it's the cap rate at some future point in time. So as a general rule of thumb, most times you want your exit cap to be higher than the cap rate for the market at the time you're buying the property. So let's just say if you're buying a property at a 5.5 cap rate right now, what seems to be fairly standard in the industry is raising it 10 basis points or so for every year that you're in the deal. Now, depending on your perspective and how bullish or bearish you are on the market, you may want to adjust that accordingly. And you also want to use the information that you get from brokers about what's happening in the market in real time. So one thing I do right now with every deal I look at is I always ask brokers where they're seeing cap rates in the market currently. And the reason I do that is because cap rates are moving very fast right now. And in most cases, they're moving up, which means that prices are coming down.
Yep.
So it's good to be current with the latest information because things are changing pretty rapidly right now.
Yeah, that's huge. And I think that's where a lot of especially beginners are struggling with, right? Because it
Yep.
feels legitimately like shooting from the hip. I mean, it that's a term we like to use in corporate when an executive asks a question you don't know the answer, you just shoot from the hip, you know.
Right. Very true.
Sorry, I want to make sure I heard you correctly, Charles. Sorry, my phone just dropped. But now I'm back. You said your exit cap rate, you want to have it at an increase of 10 basis points per year that you're in the deal from where the entry cap is. Is that what
Not
you
so
said?
much from the entry cap, but from where similar assets are selling in the market currently. So, and I'll
Okay.
give you an example. So for instance, we're buying a property now in the Atlanta market. It's a C property, and most C properties currently are trading between 5.25 and 5.5. So you would really take it off that cap rate. Like this particular property on actual numbers, we happen to get it at a 5.94, so it's a little bit above that. But I wouldn't use the acquisition cap as your barometer for where you're going to set the exit cap. Use what's typical for similar assets in the market at that time.
Okay,
And-
that makes sense. Thank you.
You're
And
welcome.
ideally, Charles, right, in today's environment, this is where the term under promise and over deliver also comes to play, right? Because
Yes.
I mean, ideally, considering where we are today, right, cap rates are rising, but the longer you hold it, ideally the cap rate becomes lower again than what you buy it for. I wouldn't maybe not say right now, but let's say towards the end of the year or something like that, right?
I would think at some point, yes, that'll start happening. You'll see a point where cap rates kind of top out and then they start reversing and start compressing again.
Yeah.
We may not get down to the 2s and 3s that we were in at the end of 2021 and early 2022, but
Yeah.
it would make sense that at some point they are going to start compressing again during the cycle.
Yeah, agreed. So Charles, let's roll back. This deal in Atlanta, right? You had this deal in Atlanta. What was it? 90? Was it also 90 something units with that partner?
Yeah. So the first one we did was 92 units,
Mhm.
and so let me also offer some encouragement. So I did not have any single family experience or any smaller multifamily. Just dove into a 92 unit. Now it did help that I had commercial real estate experience with my job, but for anybody out there who's starting with multifamily, you absolutely can do it. It just takes persistence and putting the right people around you.
Yeah, I mean, you can legitimately ride somebody else's wave, and I would encourage you actually to do that, right? And
Yeah.
here's a big nugget on that actually. As long as you're serious and adding value, people want you to ride their waves, 100%, because you can't scale time in that essence, right? Your own
Yep.
time, your personal time. So if somebody comes on, that's very enthusiastic, wants to add value, brings value to the table. I mean, who wouldn't want that, right?
Right. So keep in mind, in this business, I mean, you definitely need partners, especially if you're going to be an active person on the syndication side. You need to have people you're partnering with, and you're going to have some people you partner with and you do every deal with and you build a business together with. And then you'll have others that you partner with on one-off deals. And each of those people are going to serve a purpose, and you'll serve a purpose for them. So it's just finding those right fits and seeing who the right people are. I mean, like in this case, thankfully the sponsor had taken us seriously because he had seen that we were really working at it and we were putting a lot of deals in front of him. But the reality is, without him, we certainly wouldn't have closed that deal. Aside from just bringing us the deal and sponsoring it, we also used his property management company because he had a first party management company. So the reality is he did a heck of a lot of that deal. Now, while I had looked at probably 150, 200 deals to get to that point, it was having that connection and that relationship that allowed us to get in the first deal. And, from that point, I'll tell you that this much. Well, the first deal took 150 to 200 to look at. The second one probably took me 30. Because as soon as you have that first one, you get more credibility. People treat you differently. And what you'll see is that the more deals you do, the better access you get to better deals. So brokers take you seriously,
Yeah.
become a proven commodity as a closer. And what happens is, all of a sudden, they're not going to throw you all the dogs, for lack of a better term, of deals that they send you at the beginning. they're going to start sending you some better ones that actually make sense. So you won't need to look at 100
Yeah.
deals every time out the next time around.
That's so true, Charles, man. I tell you, the deal that we closed, like now every single time, first of all, after we closed, I got called bro. So that was awesome. You made it to the bro.
You got your bro status, Marcel.
Exactly. But the best part of it is now, every time I get a deal, from that brokerage, we don't have to send, like, Victor is our lead underwriter, right? He's the guy that dives in deep, and his time is super valuable. But the first thing I do when I get something from that brokerage, I send a one-liner and I say, worth it, question mark, and I legitimately get back like either, yeah, this one actually has some legs here and there, or I say, not yet, something like that, so there's totally onto something there for sure. So tell us, Charles, what was the for you then the journey? You closed the first deal. How much time was in between the first and the second one? And because you work on the first one, right? You want to stabilize and everything depending on your business plan, and then you run into your second one. What was that transition like?
Good question. So, we closed the first one September 2019, and I set a goal for myself that I wanted to have the second property identified and under contract by the end of 2019. So I gave myself a goal, and I fell a little bit short, but we did have it identified by January 2020 and under contract by February. So it's about a month and a half behind, but we were close. So the first one took me 2 years. The second one took me about 4 months. And we had some challenges closing that one because anybody remembers March 2020 saw a lot of change with the pandemic. So we certainly took a lot longer on that closing timeline than we expected. We still got it over the finish line. And the way I describe it, it's almost like playing a video game in the sense that every deal you close, you level up. So the second deal was a 48-unit deal, which was not really what I was looking for, because I was looking for those 100-unit plus deals. And when we got that deal presented to us, I thought about it and said, is this really a deal that I want to do? And the answer was no. But I looked at the deal. The underwriting was very solid. It was in Sumter, South Carolina. And for me, for anybody who can tell by my accent, I'm not a native Charlatan. I'm originally from New York. And I just moved to Charlotte a few months before that. And my first thought was, where the heck is Sumter, South Carolina? So we drove down to the market. We saw the property. I said, oh, this is actually a nice little section of town. Look at this. There's nice retail. There's decent living around here. And probably underwrote as well as any deal I'd ever seen. So I couldn't find a reason to really reject it other than the fact that it was just smaller than I wanted. But I thought about it and said, I could use this as a stepping stone, because it was a broker relationship I was trying to build for a while. And even though it didn't necessarily fit my criteria, what I knew it could do is open some doors and say, okay, if I get this one under contract with them and close it, maybe I can use this to get something bigger. And lo and behold, that's actually my best broker relationship. So I've closed, 4 of the 9 deals I've done with that broker. And, he's usually been the one who's pushed me further up each time. So at that point, he was pretty early in his career, and it kind of worked out that he started moving up the ladder, and then I also started growing a bit. So because of that, the next deal out was a $7 million deal with them. And the next deal after that was a $17 million deal with him. So as he kept growing, I kept growing. So it served a purpose. So keep that in mind, guys. You want to have criteria, you want to have plans, but you want to be flexible enough to adjust and adapt with those plans when needed to.
And Charles, correct me if I'm wrong here, but maybe that's a little inside Jedi trick. If you're on the newer side of things, maybe you identify, hey, maybe that younger broker that really wants to get his career launched, and you can kind of lock arms, right? And you help each other, launch into the space.
I would actually tell you that's very much an inside Jedi trick. And I think that's a great strategy. Now, we're in a period of transition, and transition in the sense that the market's changing, but also some of the players in the industry are changing. And that's both, operators, brokers, everybody, because you'll see, people that transition out and some that transition in. But if you're making relationships with those younger brokers, keep this in mind. and this is for anybody, regardless of what industry you're in. When you're younger and you have limited options and you don't have as many people knocking on your door, people always remember those who helped them and who helped bring them up to the next level. So if you're an earlier client with somebody, when they weren't a big shot, oftentimes they remember you as you move up the ladder. So just keep that in mind.
That's huge.
That's really good. I like
Everyone
that a
should
lot.
write that down, right? For
Yeah,
real.
yeah.
And you see,
Exactly.
matter of fact, how do you identify these guys, right? Is actually when you see the listing, right? And you have like 4 or 5 brokers on there. It's look at the titles, right? You see
Right.
the guys at the end, those are sometimes the ones, that you want to build the relationship with.
Right, the ones that don't have executive or senior next to their name. Now, what I would always tell anybody in here is you want to go as high up the ladder you can as soon as you can. But when you're starting out, sometimes that's not realistic. The guy who's selling the $50 million properties may not want to deal with somebody who doesn't have any deals closed. They may look at that and say, okay, it's a waste of my time. But the guy who's selling the $2, $3, $4, $5 million deals, he may be willing to give you some time because most of the buyers that he's dealing with are newer buyers. And they're people who are just starting out. So, if you build those relationships, those can be stepping stones to future deals and to longer relationships that go further.
Yeah, that's exactly what we experienced as well. Charles, let's do the following. We only have like 10 minutes, I feel like, until we need to go to Q&A and open it up here. And I feel like we could fill 3 hours again, right? Let's roll very quick as to where are you today, okay? Let's fast forward. Where are you today? And then let's go into you sharing your feedback as to current market. Where do you see it headed? What do you see on a day-to-day basis?
Sure. So in terms of the market, I think it's obviously a loaded question. There's definitely a lot of opinions there without question. My opinion right now is that I'm very bearish, probably more than most. But I think that's also going to create a lot of opportunities. So let me be clear on that. So as a seller, I'm probably not as thrilled, but as a buyer, I would do a cartwheel if I could. So, it's a good time to get ready. If you're just starting out, there's a few things you want to do. And the first one I would tell you is know what you're good at. In this business, there's really 3 things that you have to do to be successful. It's finding deals, it's finding money, and it's running deals. When you don't have any deals, running them is not so important because you need something to run first. So the earlier things are either going to be finding deals or finding money. And it's figuring out which side of that equation you fit better on, and then finding the right people to put around you and either building a partnership. And even if it's an informal partnership where you're just starting out and testing it out with the deal, that's okay. But find who those people are so you're not scrambling once you find a deal and say, okay, now I have a deal, but I have no team. So work on those relationships, and then whichever side you belong on, whether it's the finding the deals or the finding the money, make sure you're working that side actively. So as these opportunities present themselves, you're ready to go up there and be able to execute.
Love it. That's exactly what we went through as well, right? And what we're encouraging in the community as well. But the big part of it is, Charles, that I want to reiterate on is what you mentioned is try it out, right? Don't overcommit too early, right? Let's not just who wants to be on a team? You, okay, we go now and we're the A team now, right? It really, we actually call it dating nowadays, let's
Right.
date.
There's a lot of truth to it. I mean, you don't want to jump right into a long-term relationship or partnership without knowing who you're with, because you may wind up regretting that decision. So there's nothing wrong doing a test run, and then you can always figure out if it worked, and if it didn't, you make adjustments.
Exactly. So Charles, when you get a deal right now, right? When you underwrite it, what is your, how do I call it? What's the first thing you look at right now due to today's market, right? What are your fundamentals that are important to you today?
Okay. So it's often said that the 3 most important words in real estate are location, location, location. I'm going to disagree. I'm going to say the single most important word is debt. Okay. So the reason I'm going to tell you that is go back and ask any syndicator who bought a deal in the last 2 years with bridge financing and ask them how their deal's doing. Adjustable rate bridge financing specifically.
Yeah.
And I think that the overwhelming majority, I would even say perhaps all, would tell you that the deals aren't doing as great as they expected. And some of them may even be doing pretty bad. So the deals that I realize have more potential at this point are deals with attractive loan assumptions. So what I can't do today is go out and get a new loan that has an interest rate in the 3s. So if I see a deal that has an attractive assumption with an agency loan with an interest rate in the 3% range and, 5, 7, 9 years left on it, I'm going to prioritize those over deals with new financing. What I would say is that in most cases, I don't really see deals with new financing coming anywhere close at this point in most cases. I think property values probably still need to drop another 20% or so before they really realign with price. So if you have limited time, you have a lot of deals, focus on the ones with loan assumptions. Not all of them are going to work, but at least they have a fighting chance of working.
Nice. So let's sum this up, right? Number one, loan assumptions is what are the easier entries, let's put it that way, in today's market. And I must say, we can, and Victor knows this very much, every deal we've submitted this year, we came in too low, right? The too low, and didn't win it because we had a strong team, strong partners, strong sponsors, strong KP, everything, but always been too low. And I'm interested actually to see, maybe you have a take on that, Charles. Who are these people right now that come in higher? Because I believe they probably either have different strategy, different money, right? To be able to pay more.
Well, let me offer some different perspective. And in some cases, I think you're right. What I would say is there's a lot more deals hitting the market than I expected this time of year. And I think even than a lot of brokers expected. But let's also offer some perspective from a lot of the brokers I'm speaking with, and I'm sure you guys are hearing this too from the guys you speak with. A lot of those deals aren't closing.
We saw that too. Half of
Yeah.
them came back on the market.
Right. And what's happening is they're just not hitting their price. In many cases, what you have is you have a seller who has adjustable rate bridge debt, and they're testing the market to see if they can get their price. Or you have a seller who maybe just has an attractive cost basis. They've owned the property for a while, and they're seeing if they can get, a number that's enticing to them. And if they get something that either solves their problem or is enticing to them, they're moving forward. And if not, then they're going back to the drawing board. So keep in mind, guys, just because the deal goes to market doesn't mean that it's actually selling. Keep that in mind.
Yeah, that's
And
a
the
great
second
point.
thing I would tell you is you will have some people that have a need to place money. You'll have 1031 exchange buyers. You'll have, quite frankly, a lot of buyers out of New York and California. There's a lot of money in those areas. And, if they're looking in the Southeast or the Midwest, they may be buying it as a longer term play just on cost basis. And if you see something that's, $120,000 a door in one of these areas, and while it may seem expensive to somebody who's looking in the market regularly, if you're used to paying, 3 and 4 times that, maybe 120 a door doesn't seem so bad.
That's right.
So it's all in perspective. And then in other cases, you may even just see newer groups that are quite frankly overpaying because they don't know any better. So I think those are the instances of what you're seeing out there in the market at this point.
Yeah, agreed. And then what is that? What's the conclusion to that? Patience, like
Right.
you said earlier, right?
Definitely patience. Yes.
All comes around. We have a question here. Odelia is asking, are you paying a higher because the loan assumption is at a lower rate, and do they expect a lower cap price because the loan is favorable? That's a good question here.
Great question. So in most cases, no. But what I would say is that you're actually seeing deals that have a chance of making sense. So like the deal that we have under contract in the Atlanta market, that one there has an interest rate of 3.48, but we're buying it at a 5.94 cap on actual numbers. So the cap rate was very favorable. In most cases, I think unless you're looking at higher quality assets like A's or B or B plus assets, sellers are starting to get the message. I think there's some cases where they're still trying to get their numbers. Quite frankly, if they've won the last 2 years, they probably don't have much of a choice unless they're at the point where they're desperate and realize that the the ship is sinking. But what I would also tell you guys is you want to follow up. So with some of these deals that aren't getting done, a lot of them are going to be people who wind up in trouble. So if you stay in touch and you follow up on those deals, eventually when that guy gets in trouble, maybe the broker will think of you.
Yeah, that's exactly right. And that's something that, Victor, we need to do, matter of fact, on our last one here.
Yeah, I told you we need to follow up on some of these
Yep.
and we haven't
Yep.
heard from again. But Charles, and I wanted to ask you, since we are in the different market than we've been in previously, and a lot of groups have putting a pause on buying, but you guys, like you said, you guys are still buying. You guys have put 2 deals under contract in the past 3 or 4 months or so. But this might be a loaded question. How have you guys adjusted your acquisition strategy and proposed business plans to adjust to this new real estate cycle?
Great question. And I'm probably going to give you an answer that's going to surprise you. While we are being selective and we are looking at a lot of deals, I think now's actually a pretty good time to buy. Do I think prices are bottomed out? No, I think there's a lot more bottoming to go. But I'll tell you this much, as somebody who bought 4 deals in the first half of 2022, now is 100% better time to buy than it was then. It's always clearer in retrospect. So I wouldn't tell anybody to be aggressive. Now is not the time to be aggressive. But if you can find a deal with an attractive loan assumption that has a good amount of time left on it, at least 5 years, and you have an attractive interest rate and the deal cash flows, I would tell you there's no reason not to move forward. Where people are going to get stuck is when they don't have time on these loans. You have a lot of people who bought these bridge loans when they bought with interest rates in the 2s and 3s. And now they're going to be looking at interest rates that are 500 basis points higher in some cases. And they're not going to be able to refinance. So having time is key. And I would also tell you having fixed rate, I mean, it's personal preference, but I would tell you, certainly a lesson I learned from last year is I have no desire to do an adjustable rate bridge loan anytime again in the near future. So pick the right debt, get plenty of time. And if the deal cash flows with that, I would tell you there's no reason not to pursue it.
Let's go. Guys, quick question. We are at we have 15 minutes left here. I want to ask you a plain question. Are you guys getting value out of this? Is this some excellent value? If so, let's show some love for Charles here in the chat. Let's throw the fires, all that stuff. Let's make sure that he knows I'm here and I'm putting some good time in here for people. Yes, I like it. Yes, Andrea, yes, fire. Great stuff. Good. Guys, let's do this. Let's open it up for the Q&A. But before we do that, one little thing, because I want to also additionally add value to Charles. You know how I roll. Pull out your phones real quick, guys. Pull out the phones. It's picture time. Okay, here's my phone. I'll do the same thing. So get out your phones. Take a picture right now of the screen. Everybody smiles. 1, 2, 3. Hey. Yeah, exactly. Take some pictures here. And then what you're going to do is, I think Caleb is putting Charles's Instagram handle here in the chat. If not, Caleb, can you please put Charles' Instagram handle in here in the chat, or everyone's in the chat here again? Make sure you throw something out there on your channels, tag Charles and showcase really the appreciation for him bringing the time here and sharing his knowledge, right? What he has learned over the past, God, what is it now, Charles, right? 8 years? 8 years, right? Which is huge. Talk about patience, right? So let's do that there. And matter of fact, I'm sure Charles, will reciprocate that and share. And you now all of a sudden get exposed to his audience as well. Wow, look at that. One hand washes another. All right, cool. But with that being said, guys, let's kick it over to the Q&A. I saw some questions in the chat already. Matter of fact, I do want to award or reward actually the people that raise their hands and come up live and show their faces. So I see Peter has his hand raised. So we're going to go there first, and we're going to roll it until 9:30, and then we'll let you know who we got coming on next week. And we're ready for bed, right? All right, let's pull up Peter here. There you are.
Hey, Charles, just want to, thanks for being here. We really appreciate it. Like the guy said, another amazing guest. I don't know what you're going to do next week, guys, but great job once again. I didn't really specifically have a question. I just really want to thank you for what you're doing here and appreciate the fact that you kind of solidified some of the things we've already been thinking, right? And about the market in general. One of the things that I really appreciate leading the broker Zoom is we've talked about that a number of times, that, you know, a lot of times when you get the old guys that have been in the business for 20 years, they don't even want to talk to you. It's the young guys that give you time. And obviously you've got to build a relationship with as many of those guys as you can, because they're not all going to hang around, but the ones that do will really appreciate that we took the time to build that relationship with them. So I tend to focus on the younger guys, even though I'm an old guy, because they're the ones that will really, that we can really help. You know, we can help them build their business. So I appreciate that perspective. And and you got boots on the ground in Atlanta here. So if I can do anything to help you with that deal, let me know.
That's
Awesome.
right.
Thanks, Peter.
That's right.
What part of town is it in?
So we actually have two in the Atlanta market in the contract, one in Decatur and one in Riverdale.
Oh, nice. Okay. Very
That's
good.
awesome. And make sure everybody, tomorrow 8 p.m. Peter will be on with the broker calls, right? So speaking of it, already hitting the ground running tomorrow evening. Thanks, Peter. All right, we got Mario. What's up, bro? Pulling you up here. There you are.
Hey, Marcel. Hey, group. How are you? Hey, Charles.
Hey, Mario.
I spent a lot of Saturdays with this guy, so I'm glad he's on, and certainly grateful to hear share his journey with those who don't already know him. So I appreciate you guys having him on. But I had a question. I had a meeting with a banker, interestingly, on Friday, and they're advising their clients. They feel like rates are starting to top out. So instead of the conversation of if you are looking for long-term debt, look for as long as you can, fix it for as long as you can. Are you starting to at least open up your conversation to maybe looking at a shorter fixed period so that some of these deals could make a little more sense, Charles?
For me personally, no. I think at this point, time is very, very important. I'd rather lock something in now at a fixed rate for 10 years, even if rates go down 6 months from now, as opposed to taking a chance of rolling the dice the other way. It's probably, maybe I'm a little jaded from lessons learned over the last year. But unless there's a really compelling reason, I personally have no interest in a shorter term loan at this point. And to me, a really compelling reason, if I'm going to do like a shorter term bridge loan at this point, is buying a property 50 cents on the dollar. If it's anything less than that, I have zero interest in it. So I wouldn't advocate anybody do that, because I think there are times where it'll pan out, but what it doesn't do is give you the time you need through a changing market to write it out. So it basically means that you really have to be right when you're executing that plan. And if you're not, you may wind up with a mess.
Understandable. I appreciate your perspective.
So Charles, what do you consider short and what do you consider longer?
Short term, I would tell you, is 3 years or less at this point. I would recommend getting at least 5 years so you have time to write it out. For me personally, I'm really looking at 10 and 12 years at this point. So when we're locking in debt, you know, I want to get a Fannie or a Freddie loan with 10 or 12 years most times.
Boom. All right, then let's move on, right, Victor? Is that cover your answer?
Mm-hmm.
Let's go to, thanks, Mario. Appreciate you coming up here. Let's go to Fred.
Hey, Charles, thanks for taking the time and talking to us. Really appreciate it. Wealth of information. Hey, what do you, I think you said you had 2 deals. What are you seeing in the capital market? Are you seeing capital raising to be any more challenging today than maybe it was a year and a half or 2 years ago when you did the other deals?
Oh, yes, definitely tougher. So, and it's probably going to get tougher. I mean, I hate to say that, but there's probably some truth to it. There's a lot of fear in the markets, probably more than people are saying right now. And I think there's a lot of syndication investors that are jaded because a lot of deals that they probably invested in over the last year and a half or 2 years, in many cases, haven't performed the way they expected to. And the reason for that is because a lot of those deals were acquired with adjustable rate bridge loans. So when operators were predicting that, or forecasting that these loans would have 3 or 3.5% interest rates, and now they're in the 6s and 7s and 8s, that means that distributions aren't being paid, and in some cases the deals might even be lost. So a lot of investors are very wary. So I think that you definitely need to one, you need to build trust with investors and get them ready to dip their toe back in the water, for lack of a better term. And you also need to reassure them that the deal's going to have a high degree of safety. So there's two things that I'm really focusing on at this point with investors. One is the deals that we're focusing on have fixed rate debt. They have great interest rates. And those are really the main reasons why those deals pencil out and why they work. And they're also cash flowing. So like the first deal that we had in the contract this year, that's the one in Decatur. So that deal, even if we're terribly wrong, so let's say if we use the seller's in-place income with no adjustment, and we increase the tax bill for the reassessment, and we increase the insurance, that deal's still going to have a 6% cash on cash return. So if everything went terribly wrong and we couldn't increase rents at all, and we couldn't do any better than what's there now, and we still got an increase in tax and insurance, that deal would still cash flow. So investors want certainty at this point. You know, if they're going to be putting their money in, and there's no such thing as certainty in an investment, right? But they want as close to certain as they can get. You know, a lot of them have, you know, bad experiences over the last 2 years, and they need to feel safe and comfortable to dip their toe back in the water.
Can I also
Does that answer your
piggyback on that?
question, Brett?
Yeah.
Sorry. Go for it, Vic.
Yeah, can I also piggyback on that question about that investors' expectations?
Mm-hmm.
You know, so it seems like over the last several years, it's kind of been, I don't want to say it's industry standard or industry expectations for now having preferred return, because, you know, they're buying on bridge debt, they're overpaying, they can't make that cash on cash return in the first couple of years. Do you see a changing in investors' expectations now with the difference in the debt terms now? Or would you have to set that expectations?
You definitely have to set the expectation. So it's interesting. If you would have looked at deals about 9 or 10 months ago in the summer of last year, I would tell you that investors were accepting lower cash on cash returns with the idea that they were going to get those returns on the back end. Fast forward a few months to the present time. Now I think a lot of investors are realizing, crap, we're going to be holding the bag and we're never going to see that money. And because of that, I think that many of them are shifting to wanting more cash flow, because that's the part that's more controllable versus the sale, which, you know, you really can't control. And I think a lot of them are starting to realize that. So I would say the expectation, I think, is actually that many of them have gotten higher standards than they would have a year ago, and that they're expecting higher cash flow, because if they're going to put their money in, they want to have a reasonable degree of certainty that first they're going to get their money back, and secondly, that they might at least make something on it. So at least if they can see some cash flow from the property and they see some stability with a fixed rate, then they realize there's a higher probability of them actually being able to make some money on it.
Sounds good.
Thanks.
Yeah, we've been discussing that here internally as well, right? And we had some conflicting information, I would say, there, or feedback as well, you know, as to what investors are really, in terms of metrics, what they are currently accepting, what not, at what kind of asset level, etc. So that's some great feedback there, Charles. Okay, do we have any more questions? I know there was some in the chat. I do believe they were answered though. Is there any more? If not, I'm gonna call it 3, 2, 1. And want to thank you, Charles. Really appreciate you coming on a Sunday night, taking the time and dropping so much value into this here. So let's make sure, Charles, let us know, where can people find you, see you? I almost said touch, but that's not what I meant. But get access to you.
Sure. Probably the best thing is to drop my link tree in there. And I think it's been in the chat a few times, but I believe that has all of my social media links and all the different ways to reach out to me. So if you click on that, it'll direct you to everything I have, and you'll be able to reach me on that.
Love it. So guys, take advantage of that, of course. Charles, this was awesome. Would love to have you back here someday. This was excellent. I'm eager to see where you're in 3 months, or what do you even say, 3, 4, 5 months out, you know? So this was very great information. I know people are craving, including us, craving high ballers to give us feedback. Where are we today? What do you see in the day to day? You know,
Right.
so this was great information, and I
That's a
think
pleasure.
everyone can second that.
It was definitely a pleasure being here. It's a great community and a lot of energy. I love it.
Thank you. We appreciate it.
And
Thank you
Charles,
so
and
much.
just wanted to bring up attention to something else, that you guys do have a private or selective coaching program as well, right? And then
Yes,
you guys do hold a almost like an annual multifamily summit as well. You
right.
want to touch a bit on those two?
Sure, absolutely. So the summit is a 3-day event, all virtual. This year, I believe it's definitely November. I forget the exact dates. I'm thinking 15th, 16th, and 17th, but I could be wrong on that. And that's a free summit. So if anybody wants to register, they would just go to cfcsummit.com. Last year we had somewhere around 40 different speakers, a lot of the big names in the industry, with Dan Hanford and Dave Lindell and Rod Khalif and Brad Sumrock. So we hope to have, many of those names return with us this year and have them grace us with their presence and their wisdom. And yes, with the mentorship program, we certainly are open to speaking with people. If anybody's interested in that, we're glad to see if it's a good fit and if it's the right fit to help you make progress.
That's awesome, man. Especially for free. That whole thing, I know that takes a lot of time and effort to put something together like that.
More than you may realize. Last year it kind of came about on a whim, and we were debating, do we really want to get into this? And then after you started going, it's like, okay, well, you can't back out now. But definitely some lessons learned along the way, and probably a lot more time to execute and plan and kind of arrange everything than you realize until you actually get in there and do it.
Yeah, I feel you. You level up. You level up. All right. Well, Charles, 9:31. Thank you so much. We appreciate it, and looking forward to catching up soon here again and see where you're at.
Likewise. Thanks so much, guys.
Righty. Bye, Charles. All right, guys, everyone, real quick here. What we're going to do now is we will showcase you who we got coming on next week. Let me just pull that up real quick for you guys. That's just going to take 1 second. Now I am only a tech average guy, right? Give me a moment here, and then we send you off to bed. So, but first of all, make sure, of course, that you tune in tomorrow with Peter and Ed at 8 p.m. for your broker talks. And then I know on Tuesday we have Aldo, Ed, and we'll come on, talk about underwriting. We're actually about to launch for underwriting a new sequence. So that'll be shared here soon. And on Wednesday, Victor, you're back on, right? Victor, you're back on the advanced and underwriting side. So don't miss that. We'll make sure we shoot our communications. But next week, we got on Terrence Doyle, guys, the value add dad. I love that name. Man, this is a perfect name. Isn't that the value add dad? How can somebody not remember that and also feel connected to that? So we're super excited for Terrence to come in. Super genuine guy, was right on, wanted to be here as well and share value with the community. So we're super excited to have Terrence on here next week. Check him out on his Instagram so you can already see what to expect, what he's into. But the value add component, that will be a big one here next week on our Sunday activation Zoom. So with